Welcome back to the Deep Dive. Today, we're looking way, way into the future. We're talking about planning not just for your lifetime, but for a real legacy. We're diving into dynasty trusts, sometimes called perpetual trusts. It's complex stuff. Our sources really get into the weeds on long-term wealth, tax codes, all of it. So our mission today, let's unpack how these things work, look at the big tax advantages, this sort of triple shield they offer, and crucially, talk about the major trade-offs you, the creator, have to accept. It's about building something designed to last, well, almost forever.
Exactly. And the definition itself kind of gives the game away, doesn't it? A dynasty trust. It's an irrevocable living trust. Its whole purpose is providing for beneficiaries across generations, yeah? While shielding those assets from the generation sipping tax and estate taxes, it's probably the strongest tool out there for that multi-generational goal. But that trade-off you mentioned is key. Right from the start, you need a specific mindset. It's about giving up immediate control. That's huge. And look, these aren't simple. They involve complex legal setups, significant costs, both to start and to maintain. So it's definitely not a casual decision.
Okay, let's zero in on that core idea, giving up control. You said it's irrevocable. So before we even get to the dynasty part, we need to understand the irrevocable trust foundation. Why is losing control the price you have to pay?
Well, when you, the grantor, create and fund an irrevocable trust, you're basically handing over the keys. You give up the right to just change things whenever you want. The terms are locked in. And the legal point, the reason for doing this, is to shift those assets. They move from your name, legally speaking, into the trust's name. This gets rid of what the law calls incidents of ownership.
Incidents of ownership.
Yeah.
Okay, so removing those, what does that actually do for the person setting it up?
It does two really critical things. First, because you don't legally own the assets anymore, your personal creditors can't touch them. That's big. Second, and this is vital for the legacy part, the value of those assets gets pulled out of your taxable estate. The government essentially agrees you don't own or control it, so, you can't be taxed on it when you pass away.
But giving up all control, that sounds, well, frankly, terrifying for some people. Like, what if circumstances change drastically? Can you really not get those assets back? Is there any flexibility at all?
Yeah, that's a very real concern. And modern trust law has evolved a bit to address that anxiety. While you give up ownership, you can still weave in some influence. For example, you could grant a power of appointment to a beneficiary. That lets them make certain changes down the road, maybe adjust who gets what within limits you set. And there are other modern tools, too. Our sources mention decanting. It's a great term, actually. Think of it like carefully pouring wine from an old bottle into a new one. You're moving the trust assets into a newer trust structure. This lets you update provisions, adapt to new laws, that sort of thing. You can even sometimes change the trust's home state, its domicile, to get better tax treatment or longer duration rules.
Decanting, like a legal refresh. That's helpful. Yeah. And just quickly, we should contrast this with a revocable trust.
Right.
The kind most people are familiar with. That one offers total flexibility. You can change it any time.
But zero creditor protection and zero estate tax benefits. Because legally, the government still sees those assets as yours. You haven't really given up control.
So it really is a fundamental trade-off.
Yeah.
Control versus protection and tax benefits.
Precisely.
Okay, so that's the price. Giving up control via irrevocability. What does that sacrifice really buy you in the long run? It buys you time.
Yeah.
Massive amounts of time.
Yeah.
And that leads us to the dynasty part, this idea of perpetual duration.
Right. It means the trust is built to last as long as legally possible. We're talking potentially spanning many, many generations. It's designed to keep working for decades, even centuries, providing that financial security for descendants. And this long duration lets the wealth inside compound and grow over time, mostly shielded from taxes chipping away at it.
We say perpetual, but it's not literally forever, is it? It bumps up against state law. That's the rule against perpetuities. It sounds quite old-fashioned.
It is old-fashioned. It's this complex legal doctrine that limits how long property can be tied up in trust. Each state has its own version, its own limit. Some used to be quite short, relatively speaking. But here's the key for dynasty planning. Many states have realized there's business in attracting this kind of long-term money, so they've aggressively extended their rules. Some states now allow trusts to last for, say, 360 years or even longer. Some have effectively abolished the rule.
Wow. Okay, so you pick your state carefully, and the structure itself, how it functions over that long time, the core assets, the principal, it just sits there growing, protected from taxes and creditors.
Essentially, yes. The principal is preserved. It grows inside the trust, sheltered from estate tax at each generation's passing. then the income generated by that principal, dividends, interest, whatever, that's what can be distributed out to the beneficiaries over the generations.
It's like a tree where the trunk keeps getting bigger and stronger, tax-free, and the fruit gets distributed each year.
That's a pretty good analogy, actually. The core stays protected, feeding the future.
Okay, let's shift to the real engine here. Taxes, or rather, avoiding them. Our sources talk about a triple tax shield. What are the big three taxes that these trusts are designed to defeat?
Right. The big ones for large estates are, first, the estate tax, the tax on your assets when you die. Second, the gift tax, a tax on large gifts you make during your lifetime. And third, the generation skipping transfer tax, the GSTT. A dynasty trust takes aim at all three.
That GSTT. That one seems particularly relevant for dynasty planning, going across generations. It applies to gifts or bequests to people more than one generation down, right, like grandkids. Or even someone unrelated who's at least 37 and a half years younger.
Exactly. And it's brutal. It's levied in addition to any estate or gift tax already due. It can be a massive hit.
So how does the trust structure get around these?
Okay, this is where it gets powerful. Those three taxes, estate, gift, and GSTT, they all share one combined lifetime exclusion amount. Think of it as a big voucher you can use against those taxes. Our sources give us the numbers. For 2025, that unified exclusion is $13.99 million per person.
And there's that legislation mentioned, the One Big Beautiful Bill Act. That permanently bumps it up, right?
Yes.
Like,
Yes. Crucially, starting January 1, 2026, it permanently increases the exclusion to $15 million per individual. And importantly, it will be adjusted for inflation each year after that. This stops it from snapping back to a much lower level, which was a big planning headache.
so $15 million plus inflation per person. How does that connect to the trust?
Here's the key move. When you set up and fund the Dynasty Trust, you allocate your lifetime exclusion, that big $15 million voucher, to the assets you put into the trust. You essentially spend your exclusion on the trust contribution.
So you transfer the exclusion to the trust, covering the initial gift.
Exactly. And because you've done that, and the trust now owns the assets.
The assets are outside your estate, so no estate tax when you die.
Correct. But it gets better, because the trust is set up to benefit multiple generations.
When your kids die, there's no estate tax on the trust assets either, because they don't own them.
Precisely. And distributions made from the trust down to your grandkids or great-grandkids aren't hit by that nasty generation-skipping transfer tax because your initial exclusion allocation covers all future transfers from the trust.
Wow, so the estate tax basically gets skipped for potentially centuries until the trust finally terminates way down the line based on state law.
That's the plan. It gives descendants a huge amount of time and certainty. And another neat point, even the income paid out to beneficiaries generally doesn't balloon their personal taxable estates when they pass away, as long as the core assets generating that income stay locked inside the trust. It really builds a firewall.
Speaking of firewalls, let's talk protection beyond taxes, creditors. This seems like a huge benefit for the beneficiaries themselves. What exactly are these assets protected from?
It's incredibly comprehensive. Because remember, the trust owns the assets, not the beneficiary. So if a beneficiary gets into financial trouble, their creditors generally can't touch the trust assets. The sources list the big ones. Lenders trying to collect on debts, hospitals chasing huge medical bills, courts awarding damages in a lawsuit.
And the classic one.
And yes, spouses and messy divorces. The trust assets are typically shielded from being split in a divorce settlement. That provides enormous peace of mind for the family line.
That's major protection. But what about the person who set it all up, the grantor? They gave up ownership, but do they retain any influence? You mentioned setting rules.
Yes, this is a unique aspect. While you lose ownership, you, the grantor, get to write the rule book for the trust when you create it. You can dictate the terms and conditions for distributions. This allows you to embed your family values, potentially for generations.
Can you give some examples, like what kind of rules?
Oh, all sorts. You could say stipulate that distributions only start once a beneficiary reaches a certain age, or maybe graduates college.
Or maybe they have to hold a job for a certain period.
Absolutely. Or achieve a specific goal, maybe something charitable. You could tie distributions to milestones that reflect what you believe is important.
So you're not just passing on wealth. You're potentially passing on, or at least encouraging, certain behaviors or achievements, shaping the future in a way.
It's a powerful lever, yes. You can try to guide future generations away from wasteful spending, perhaps, or towards education or philanthropy. It raises big questions about stewardship, really. What responsibility comes with that inherited wealth?
Okay, it's powerful, long-lasting. but not without challenges or complexities, especially modern ones. Let's touch on retirement funds. The Secure Act came up in our sources. How did that complicate things?
Ah, yes, the Secure Act. This threw a bit of a wrench into things for retirement accounts like IRAs or 401ks held in trust. Before the Secure Act, beneficiaries could often stretch distributions from an inherited IRA over their own lifetime, meaning decades of tax-deferred growth. But now, for many non-spousal beneficiaries, including trusts set up for them, the rule is generally that the entire retirement account must be distributed and therefore taxed by the end of the 10th year after the original owner's death.
10 years. That's a huge acceleration compared to a lifetime stretch.
It is. It significantly reduces the tax deferral advantage for retirement assets inside these trusts. It doesn't kill the strategy, but it makes it much less attractive for those specific types of assets. Needs careful planning.
Okay, so we've got the high initial and ongoing costs, the fundamental loss of control, and these newer complexities like the Secure Act. Let's bring it back to the listener. Who is this really for? When does a dynasty trust make sense versus maybe being overkill? What's the threshold?
Well, think about that lifetime exclusion amount we talked about, $15 million per person, indexed for inflation starting in 2026. If your total estate is likely to stay comfortably under that amount, or double it for a couple, then the complexity and cost of a dynasty trust might outweigh the tax benefits.
Because your estate wouldn't face federal estate tax anyway.
Right. These trusts are primarily tools for families whose wealth is expected to significantly exceed those federal exemption limits, potentially growing much larger over multiple generations, making that long-term tax shelter incredibly valuable.
So it's really for the long game, for substantial wealth expecting substantial growth.
That sums it up well. Dynasty trusts are incredibly potent for high net worth families focused on legacy, tax shielding, and creditor protection across generations. But it all hinges on that willingness to give up direct control today for benefits far in the future.
So if you're listening and this sounds like it might fit your goals, the clear message is understand deeply what giving up control means and absolutely get professional advice. You need someone who understands your state's specific rules on trust duration, that rule against perpetuities, because that dictates how long this powerful structure can actually last.
Couldn't agree more. And maybe that leaves us with a final thought for you, the listener, to ponder. If you could lock away your wealth today, give up ownership, but write the rules for the next 100, 200 years, what would those rules be? What milestones, what conditions would you set to ensure future generations truly benefit? Would you prioritize stability, education, philanthropy? Maybe something else entirely. A dynasty trust lets you try to codify those values into financial reality long after you're gone. It's a profound decision.